Chapter number 1 starts to look at the conceptual framework. The conceptual framework is all to do with the rules, the regulation that governs preparing financial statements. We start with the structure of the regulatory framework. The idea behind the regulatory framework is to provide our users with a basic minimum amount of information. We are ensuring that the information that is provided to users of financial statements is comparable and consistent. And the idea is to increase the confidence of the users and ultimately regulate behaviour of companies and directors for investors. We start at the top of the regulatory framework with IFRS Foundation. That is the International Reporting Standards Foundation. This is the supervisory body. The idea behind the body is it gives a political front. It allows for the structure to be properly funded. And ultimately, the IFRS Foundation is looking to develop high quality, understandable, enforceable reporting standards. Below the IFRS Foundation, you will find the IASB, the International Accounting Standards Board. The board physically issues accounting standards. They create the rules that govern preparing financial statements. At present, there are two types of rules: International Accounting Standards, IASs, and International Financial Reporting Standards, IFRSs. It is the responsibility of the International Accounting Standards Board to develop and publish the rules. Moving down to the IFRIC. The IFRIC is the International Financial Reporting Interpretations Committee. The idea behind this committee is to assist the International Accounting Standards Board on areas that are conflicting. So where we have an accounting standard or regulation like the Companies Act, and there are conflicting interpretations, the IFRIC will support the IASB in understanding the conflict. They work closely with national standard setters to understand where there are grey areas and where there needs to be improvements to standards. And then finally, on the right-hand side, we have the IAC. The IAC is the IFRS Advisory Council. The Advisory Council advised the International Accounting Standards Board on agenda decisions and priorities in the board's work. They are there to prepare and give advice to the board and to the trustees of views of global organisations. So 4 key areas of the regulatory framework. Please make sure you learn the 4 areas, as you may potentially get a 2-mark question in this area. Moving on to the conceptual framework then. The conceptual framework was last updated in 2010, and the idea behind the conceptual framework is to assist the board of the International Accounting Standards in developing new standards and reviewing existing ones. They ultimately are there to harmonise the accounting standards and procedures undertaken. And they will provide information and focus in terms of the users of the financial statements and any economic decisions that they may base on the financial statements. The ultimate objective of the conceptual framework is to provide information to users to aid decision making. There are 4 key areas that are covered by the conceptual framework, and we'll look at each area in a bit more detail. Firstly, the objective of financial statements. We then look at the qualitative characteristics, any underlying assumptions, and then elements of financial statements. As mentioned previously, the fundamental objective of financial reporting is to provide users of financial statements with relevant information to aid decision making. They are able to make economic decisions. An example of the type of economic decisions that may be made is if we have an investor in the business. They will be interested in the financial statements due to a number of different reasons. Number 1, should they retain their investment in the business? Number 2, should they sell off their investment in the business? Or number 3, should they actually invest more in the business? To understand the conceptual framework, we need to understand the different types of users that will be using financial statements to make decisions. The following list gives you a couple of key users of financial statements. You may come across users of the financial statements being called stakeholders. A stakeholder is purely somebody that is interested in the financial statements. If we start with investors, investors may be interested in the financial statements for, again, those economic decisions. Should I buy into the company? Should I sell my investment in the company? Or should I hold on to my investment in the company? Second type of stakeholder group, employees. Employees will be interested in the financial statements to understand job security. Is there any employment opportunities and job progression available for me? Can the company continue to provide me with my remuneration and benefits? We also have lenders of finance. Lenders of finance may be interested in information of the business in relation to debt that has been provided to the company already. The lender is going to be interested in whether the company can continue to repay capital and interest repayments on the liability that is outstanding, or if the company are looking to take further debt, can the business afford to take on this further liability? Can the business afford to repay this liability? We can also have suppliers that are interested in the information within the financial statements. Suppliers are going to be interested, again, similar to lenders, from a twofold perspective. If they are already providing you with credit, goods in advance of payment, then they want to ensure that the business is capable of paying for the goods or service that has already been provided. If you are looking to utilize a new supplier, the new supplier is going to take into account whether the business is capable of paying for the goods or service. Should they risk providing the company with goods or service in advance of payment? We can also have customers interested in the financial statements. Customers are going to be interested in the financial statements to ensure that they can continue to gain the goods or service required from the company, especially if there is long-term involvement, a necessity for the goods or service the business provides. Governments and their agencies are going to be interested in the company. One of the main reasons they're going to be interested in the company is to assess the business for tax owed. Other reasons government might be interested is to have information for national statistics and ultimately regulate the activities undertaken by the company. And the last stakeholder group that we're going to talk about is the general public. Organisations affect members of the public in a variety of ways. If there is a local economy that is reliant on an organisation to provide employment, then the local economy, by providing employment, will have a greater disposable income. Those individuals employed will have money to spend within the economy. The general public may also be interested in the company in terms of activities undertaken. Are they acting socially responsible or in the best interests of the environment? The conceptual framework came up with qualitative characteristics, and these qualitative characteristics is basically saying how businesses can provide useful information. So characteristics that the information of financial statements should meet in order to be useful. Okay? There are two categories to this. The first one being fundamental and the second being enhancing qualitative characteristics. Starting with fundamental. There are two types of fundamental qualitative characteristic. The first one is relevance. Information is said to be relevant if it has the ability to influence the economic decisions of its users. Second characteristic is known as faithful representation. Faithful representation, it is complete. It contains all necessary descriptions and explanations. Secondly, the information is neutral. It is free from bias. It is accurate. Its presentation or its selection will not influence users. And ultimately, it is free from material error. Free from material error. Material at this stage, just think about material as being a high value. So there are no large errors within the financial statements. We're going to talk about this idea of materiality later on. We then move into the enhancing qualitative characteristics. The first of them is comparability. So I am able to compare my financial statements over time. I am able to compare my financial statements year on year, or I am also able to compare my financial statements with other entities, specifically other entities being competitors. For information to be comparable, we need to disclose exactly what we are doing. If we change any of our judgments within our accounts, we need to inform our users within the notes. And we need to apply the rules consistently. The second characteristic is known as verifiability. Verifiability, I am able to confirm the value. So I am able to confirm the value. The fact incorporated companies undertake an audit each year supports this idea of verifiability, because remember, an audit is providing an opinion as to whether the financial statements show a true and fair view of the company. There are two types of verifiability: direct and indirect. Direct verifiability, an example would be that the business owns inventory and we look to actually physically do a stock take of that inventory. Whereas indirect, we would look to recalculate the value. The third enhancing qualitative characteristic is timeliness. We need to provide users with information in a timely manner in order so they can make effective decisions appropriately. The older the information provided, the less useful for decision making. So the older the information provided, the less useful for decision making. And the final concept, understandability. Understandability. It is deemed that users of financial statements have a reasonable business knowledge. They understand the economic activities of the business. Therefore, we will use accounting terms within the financial statements. Fundamentally, under the conceptual framework, there is an underlying assumption. That underlying assumption is known as the going concern concept. And the going concern concept is the idea that all financial statements are prepared on a going concern. Going concern means that the organisation is able to continue to trade for the foreseeable future. So going concern is the idea that the company can continue to trade for the foreseeable future. The foreseeable future is at least 12 months. If the business is unable to continue to trade for the next 12 months, we have to prepare our financial statements differently. That is known as a breakup basis. Under a breakup basis, the financial statements no longer have any non-current items. Everything will cease within 12 months. Therefore, we have no non-current assets and we have no non-current liabilities. They will be sold or repaid within 12 months. There's a number of other principles that you do need to be aware of for this exam. The first one is known as the accruals, or sometimes referred to as the matching concept. The idea of the accruals concept is that revenues are recorded when they are earned and expenses are incurred. There is no regard to the timing of cash payment or receipt. You match the revenue earned with the expenses incurred to earn that revenue in the financial year that it relates to. The second concept is consistency. Consistency is the ability for users to be able to compare the company's performance over a number of different years. We apply the accounting standard, we apply our judgments in a consistent manner to allow that comparability. The third point, known as duality. The duality concept is the start of double entry bookkeeping. And the idea is for every transaction, it has at least two equal effects. Therefore, under the duality concept, for every debit you post into your system, there must be an equal and opposite credit. Final point, the business entity concept. For accounting purposes, every business is regarded as separate. It is distinct from its owners. So for accounting purposes, every business is distinct. It is separate from its owners. When we actually look at the legal concept here, we have situations with sole traders, for example, whereby the business is not separate from the owner. A sole trader can be held personally liable for the business debts. However, when we produce financial statements, the underlying concept is we produce them on the basis that the business is separate. It has its own assets, liabilities, and capital. We do not record the owner's personal activities. Next concept is the idea of the time interval convention, also sometimes referred to as the accounting period convention. The idea behind this convention is that for the purpose of financial statements, we will divide the financial statements into periods. So we will produce our financial statements annually, normally every 12 months. The second concept, known as the money measurement concept, is the idea that we will account for items whereby we can attach a monetary value. So we cannot account for items where there is no monetary value. Thirdly, substance over form. In accounting, you record the economic substance of a transaction rather than its legal form. The best example I can provide you of substance over form is a company acquires a non-current asset under a hire purchase agreement. Legally, the company never owns that non-current asset until the final instalment has been paid. During the process where they are paying the instalments, we will record an asset in our accounts and a corresponding liability for the amount we need to pay over to the hire purchase company. And finally, historical cost. This means that transactions are recorded at their original purchase cost, their historic cost. That leads me to the end of chapter number 1. Please review your full session notes in this area.